Today we're going to talk about 6 golden supply and demand trading rules, and I've prepared a lot of interesting trade studies that will help you master supply and demand trading. First tip, higher time frame supply and demand zones always be lower time frame zones. So we always start our analysis on the higher time frames, and there is where we look for zones. So here you can see this is a chart. In red and green you have supply and demand areas. By the way, this is an indicator that automatically plots supply and demand areas. If you want to learn more about it, make sure to check the video link in the description below. And when we zoom out, you can see where is this zone coming from. It is right here. This is where the indicator detected that supply and demand area. And when the market moves into this area, that is where we get interested. It doesn't mean that we automatically trade them blindly. I'm going to talk about this in the later part of this video, which is very important. But a supply and demand area is an area where something may happen in the future, so it's really important that we are aware of it. It's a high impact and high probability price area. And you can see how the market is moving into it with a strong uptrend, and then it seems like we are encountering a little bit of a struggle here. It's not easy for the market to just keep going like it did in the past. When we go now to the lower time frame, there is where we look for microstructure. Microstructure, in this case, you can see we have a double top. We have a very nice support area and a resistance area. The market is in a mature uptrend. We have multiple trend waves to the upside, and it seems like the market is struggling a little bit. The market is continuing to struggle. You can see if we add the RSI, we have a divergence here, which further confirms that the bullishness is slowly fading. It doesn't automatically mean that the market is going to reverse, but it is our first heads up, or rather the second heads up after knowing the higher time frame supply areas there. We can also add the 20-period moving average, which is a very important trend filter, and we can use that for later for stop loss placement and also for retest and pullback trading. We can come up with a trading plan. The trading plan would look something like that. We wait for the breakout beneath the support level. We would like to see the market retest the previous support as resistance, and then that's where we look for continuations. So this is what happens. The market made another run at the highs, retested the highs here, wasn't able to break higher, which is a very good sign in the overall context. It adds another layer of confluence to the chart, and then you can see the market here broke convincingly below the last lows. You can see that very nicely. Now you can see the market is coming back into this area from below, so previous support may be turning into resistance. You can see the moving average is also coming into this area to provide even one more layer of confluence. And you can see after this retest confirmation at the moving average at the support area, after the triple top with the fake breakout, that is then where the market really rolled over nicely. So we have our first trend wave, second trend wave here, where we are encountering the pullback, and then we are getting into the third trend wave. The second tip, trade fresh zones only. What does this mean? So here you can see the indicator picked up some supply and demand areas, and here in the green demand area, it was created here. The market moved into it once, twice, 3 times. First of all, something that's really interesting and a very common phenomenon is that the market on each subsequent and following move into the zone moves a little bit deeper. This is a very common effect. You will often see that with support and resistance as well. It shows that the level is weakening, the market is faking out the lows, it is testing the orders underneath it and slowly picking up more buying interest. It also shows that the zone is weakening a little bit. Usually on a strong zone, you will see that the market is barely able to dip into it, maybe even reacts at the highest point already. But if the market is able to move into the zone so deep, it shows that the buyers are not as interested, they're not ready to push the price up as quickly anymore. And you can see the market shortly afterwards collapsed. Here you can see we made another fake out. We put in here pre-breakout a lot of lower highs, which is also a very important microstructure. And this is something that you can use on both ways. First of all, if you're looking for a bullish continuation, make sure that you don't trade the 3rd, 4th, 5th touch point. Or if you want to fade supply and demand areas, then look for those signs, the market pushing into the zones deeper and deeper, eventually breaking out, and that may be also the foundation of a potential trading strategy. Next tip, Supply and demand spikes occur very frequently, but that's okay because we don't trade supply and demand zones blindly anyway. And this is how it looks on the charts. The market picked up here a supply area, and then on the mature uptrend, the market moved into the zone, but didn't only move into it, but spiked completely through it. So this is very common. First of all, it doesn't make so much sense to look for bullish trades up here anyway, after the market has made such a long uptrend. And a lot of traders will use that as a foundation for their trading strategy. So what this means is that you have your confluence, you're in a mature uptrend, you have a spike here, a strong reversal to the downside. You have a 1, 2, 3 pattern here, which is a very strong reversal pattern. And if you add a higher time frame confluence on top of that, you may have 5, 6 positive confluence factors which may help you find reversals. So if you, for example, have on the higher time frame the bias that you're looking for a short, and then you have something like that on the lower time frame, this can help you with your trade timing. We have a support area or resistance that turns into support. We can use that for our entry timing as well. So it's a very interesting pattern, and I would really recommend that you start paying attention to those spikes. Let's talk about stacked zones and what does it mean when the price gravitates towards the lowest. So very often when you pull up a chart and you mark supply and demand areas, you will see that there are often phases where multiple supply or demand zones are stacked on top of each other. So you can see right here at the bottom, we have 1, 2, and 3 demand areas on top of each other. And the way this is often playing out is that the market is eventually pulling into the lowest. It's very common to see that the market is breaking through the other zones before that. Sometimes you see a small reaction of the zones, but ultimately, it's very common, not obviously 100%, but it's very common to see the market move all the way into the lowest zone and then there show the strong reaction. It's a very common phenomenon. So in doubt, when you are pulling up your charts and you see multiple zones and you don't know what to do, focus on the highest or the lowest one. In the case of a downtrend, in the lowest. In the case of an uptrend, focus on the highest one. And that is often where you can expect the best reaction. This is a tip that is not only applicable to supply and demand, but also to support and resistance or any other confluence tool. And we always want to make sure that we wait for a reaction on the higher time frame first. We are not going to trade a zone blindly just because the market is giving us a supply and demand area and the price is touching it. It doesn't mean that we automatically going to jump in a trade. So how this looks on a multi-time frame approach. Here you can see the market was in a downtrend, has been trading sideways a little bit, and it seems like it's bouncing back and forth between the supply and the demand zone here. The market has just strongly moved into the zone here. So although there is a red supply area, it doesn't mean that we should automatically buy it. We're going to wait a little bit longer and see is the market reacting to it, yes or no. The market, although the supply and demand areas are high probability, there are going to be times where the market just doesn't care about the zone and just breaks through it and never looks back. So you can see here, just waiting one more candle provides a very different picture. Here we have now an engulfing body candle. It completely engulfs the previous body of the candle, a much stronger selling and short signal. Still not enough, obviously, so we're going to jump to a lower time frame all the way to the 15-minute. And here's where we want to execute our trades. We're going to create a trading plan and see what we have. So we have here this channel. We have a triple tap. From the second to the third tab, you can see we have a strong divergence. The market is almost not able to make a higher high. And even after making the higher high, the market is completely reversed very quickly. So a lot of selling pressure is coming in and not a lot of bullish pressure is here anymore in the market. To the downside, we have here the potential trend line and we mark the last swing low. For our trading plan, you can see the market is continuing to move lower into the zone. And for a trading plan, we could wait for a break and a retest, a very simple approach. We could add a moving average later on as well if we want, but for a start, that could be a trading plan. And you can see this is what happens. The market broke below it, then moved into the area, and then moved away. This is a very common behavior. A lot of traders are too aggressive, and as soon as the market hits this area, previous support turning into possible resistance, they're going to jump on this. In my experience, I would always recommend wait just one more candle to see if you really have a reaction. Sometimes the market just falls back in the range, and you can avoid such trades that you don't want to be in very easily. So just wait one more candle. Here you can see the market moved lower a little bit, and now it's giving us a corrective wave. So you can see a very common behavior, nothing yet to be really worried about, because after a strong bearish phase, you expect the market to pull back a little bit. And to know about this natural rhythm of the market, the impulsive corrective waves can help you trade with a little bit more confidence. For ultimate targets, we activated the supply and demand indicator again, and you can see the indicator provides here two zones on top of each other. So if you're looking for a target, it would be wise to think about getting out of the trade here a little bit above the zone. And eventually this is what happens. You can see after this short corrective wave, the market resumed, made another impulse wave to the downside before reaching here this lower zone. So very, very nice higher to lower time frame. After reaching the zone, the market moved sideways, so would have been a good time to get out of the trade, even if you use the zone maybe for just executing a partial exit, so exiting 25, 30, 50% of the trade. After you see the market is dead and sideways, then it's a good time to get out, because now it's not a high probability trade anymore. Let me show you another way of using supply and demand for a top-down strategy. We start with a higher time frame, and then we execute a trade on the lower time frame. So we have here a market that is overall range bound. This is the daily time frame, and you can see we have a downtrending phase, an uptrending phase, a downtrending, and an uptrend. And you can see the market is very nicely responding to previous supply and demand areas. This downtrend is finding its end and reversal point here at the previous zone. Then you can see the market move back into the previous high, reversed back into a previous zone, and now is back at a red zone. So now it would make sense at the boundaries of this resistance area to look for a bearish turnaround. Since we are in a range market, that makes sense. We can already see that the market is giving us here a deceleration candle, so the candles are getting smaller, strong bullish candle, less strong, and then doji, clearly a sign that the bulls are slowly exiting the market. On the lower time frame, on the 1 hour, you can see this market very, very nicely. What we have here is a trend above the EMA or the 20 period from the higher time frame. So on the lower time frame, it makes sense to add a higher time frame moving average as an additional trend filter. And when we want to come up with a trading plan, what we want to do is we want to trade on the lower side of the moving average. If we betting on the short side, just waiting for the market to cross below this higher time frame moving average, also get below this flip zone, previous resistance, turning into support. This could really enhance our decision making and increase the likelihood of finding a profitable trade. You can see afterwards the market broke to the downside. Really is nicely falling through this support area. The market is retesting the moving average and also the flip zone. So we have a very nice area of where we would expect a retest, and it seems to be happening exactly where it makes sense. So getting into the trade here on the pullback would make sense. If you are a little bit more of a less aggressive trader, you could wait for the market to break into a new low. And for stop placement, you would like to place your stop loss out of the way. Maybe move it above the last swing high here, definitely above the moving average, definitely above the zone, and also above the last high. Add a little bit of a volatility buffer so that you are not as easily kicked out. You can see we can add the supply and demand areas, so we have an idea for target placement. So here is a demand area that the market and the indicator is offering. It makes sense then to have your target a little bit ahead of this zone. And you can see what happened afterwards. The market moved lower, moved back into the area. It depends on your stop loss approach. Would you have stayed into this trade, yes or no? Eventually the market would have moved into the target. However, there's a high chance that you probably would have exited around here. So what I want to show with this example is that nothing works 100%. Supply and demand is a great add-on and a filter to your trading. It can help you pick areas where it makes sense to look for trades. Then go to the lower time frame, look for pinpointing and snipering into your entry, and then it is up to you to manage your trade, put your stop loss at the right position, and let the trade unfold.